What's up, guys? Welcome back to GTech Finance. So, blood. Stock market is bleeding, and bleeding. So, when it comes to indexes, the S&P 500 dipped on Thursday, continuing its volatile run in March, as the rally to record high breaks just took a pause, with investors reassessing the growth picture. So, the Dow also slid 60 points, while the S&P dipped 0.3% for a third straight day. The Nasdaq composite fell 0.5% as big tech came under pressure again, with bond yields going up. Netflix fell 3%, Amazon, Microsoft, and Alphabet all declined more than 1%. Oil prices fell about 4% Thursday as demand concerns rekindled with fresh COVID pandemic lockdowns, and the S&P 500 energy sector slid more than 2%. One of them making the biggest moves is Exxon, going down near 3%. The market weakness came as Federal Reserve Chairman Jerome Powell hinted that one day starting to remove the stimulus that has boosted the market during the pandemic. As we make substantial further progress, I quote, towards our goals, we'll gradually roll back the amount of treasuries and mortgage-backed securities we've bought, Powell told NPR's Morning Edition. We will very gradually over time, with great transparency, when the economy has all but fully recovered, we will be pulling back the support that we provided during emergency times, end of the quote. Three major averages are all on track to post a losing week, with the S&P 500 and the Dow falling 1% each. Nasdaq has fallen more than 2% this week. The S&P 500 and the blue chip Dow hit their record highs last week. The tech-heavy Nasdaq has been the relative underperformer, with a flat return this year compared to the S&P's 3% rise. Some investors have been taking profits in their growth winners, which led the markets rebound from the pandemic losses last year. Open the quote. So, the weakness in technology and tech stocks is undeniable, but it likely won't be a straight line down for the sector, and there will be zigs and zags along the way, said David Bahnsen, Chief Investment Officer at the Bahnsen Group. Tech stocks valuations are too high and are screaming for correction. So the pressure on equities come as the bond yields continue to decline from recent highs. So the 10-year Treasury yield dipped from the 2 basis to below 1.6%, falling for a fourth day, after the rate hit a 14-month high last week, which we know caused a massive sell-off, and it was really bad, but now it's just continuing. Economy is improving though, so the Labor Department said first-time claims for unemployment insurance totaled 684,000 for the week ended March, which was lower than the estimate of 735,000 jobless claims from economists surveyed by Dow Jones, which is a good sign. So the sign of strength from today's jobless claims read may actually have a perverse effect on the broader market, said Mike Lowengart, managing director at E-Trade. He said that, meaning if we continue to see the labor market make strides, this could translate into pressure on equities and on the Fed to reassess its accommodative stance. So yeah, that's basically it. So economy is doing relatively well, according to the stats, where it's in a recovery, V-shaped recovery. So between the stocks that actually made a lot of moves, we're not going to talk about all of them, but first of them, we have to talk about GameStop. So this stock looks like it's back at it again. So shares rose 31% in midday trading as the volatile video game retailer stock looked to snap a losing streak and curb steep losses from the prior session, which reported the fourth quarter earnings on Tuesday, and that caused the stock to dip a lot, about 20% so far this week. This was really shocking. We also have Nike. So shares of the sportswear big company dropped more than 4% after a statement surfaced on Chinese social media in which the sports giant said it was concerned about reports of forced labor in Xinjiang, which caused the stock to go down massively. And so we also have Cisco Systems, which is the tech stock that had 1.6% after Goldman Sachs upgraded Cisco to buy from neutral. Goldman said in a note that the potential for increased spending by businesses to make their offices better for video conferencing presents fundamental upside for Cisco, which was good news and made the stock go up. And when it comes to COVID, so Biden announced a new COVID vaccine goal. He wants to reach 200 million shots within his first 100 days, which goes down to 2 million shots a day. And we can say also that, and if we want to go to a bigger picture, what you can see is after a big run of this year, the bull market is over for some of the stocks. So we can see that we have a lot of tech stocks which were above the Wall Street target. Probably a lot of people are going to hate me for saying this, but we can even see Tesla. I mean, it went to 900. 900, in my opinion, was a bit too inflated for it. So I find it more logical to be at around 630, go to 650, maybe 700, 750. 900, it will reach it at the growth it's going to reach it very soon, but I don't think it was at the time worth $900. So the stock market has been a furious rally over the past 12 months as investors focus on an economic recovery, but the optimism for some stocks has gone too far, like we saw before with Tesla a bit. So that's according to Wall Street analysts. So the bounce from the bottom on March 6th, when the illness came and everybody panicked, was really dramatic. We saw some stock double and triple in price. We even had Apple that dropped and tripled, Tesla 6x, if not more. We have a lot that did this. So we had stocks that were already trading at, I'd say, probably 5% above their Wall Street price target, and so it was way too high. Their assets were way too inflated, and I think some of them it was good that they came a bit down. So Jerome Powell spoke, and when so the Fed chairman said the economy has recovered more quickly than expected, thanks largely to stimulus and vaccines. He praised the recovery and sees Fed pulling back help after substantial progress. And the powerful fiscal help from Congress combined with accelerated vaccine distribution has allowed the United States economy to recover faster than expected. That's according to Fed Reserve Jerome Powell, that said what he said Thursday. He said that at some point that will allow the central bank to dial back the help if it has provided, though he said now is not the time. I quote, as we make substantial further progress towards our goals, we'll gradually roll back the amount of treasuries. I said it before, but I'm saying it again. And we will very gradually and over time, with great transparency, when the economy has all but fully recovered, we'll be pulling back the support we provided during emergency times. So, you can remember that at the beginning of the illness, when the first thing the Fed did was actually set the short treasury bonds to a yield of near zero, historically low. And this was like emergency mode. It just snapped after like 1 week. They're like, okay, bonds back to zero. We bought everything. And so Powell and other Fed officials have pledged to keep that accommodation in place until the economy reaches full employment, and inflation, which is averaging around 2%. So inflation is a big subject because there might just be that scenario where they'll find a way to just not hide inflation, just it's going to stay low maybe, because he says that we're still averaging around 2%. Maybe we're going to go a bit higher, but long term it's going to be the same. So he said in a nutshell, it's a combination of better developments on COVID, particularly the vaccines, and also economic support from Congress. That's really what's driving it, he said. And that's going to enable us to reopen the economy sooner than we might have been expecting. And the US, it's important to know, they have vaccinated close to 2.5 million people per day, which is huge. And I think if the economy is recovering that quick, it's largely because of the $4 trillion and $3 trillion stimulus bills. And we might have this huge $3 trillion bill of infrastructure coming quite soon in a few months. So I think that's it for today. If you enjoyed the video, hit the like button, subscribe to the channel if you haven't already, and hope to see you guys next time.